Hey everyone, and welcome back to the next video in the 8 trading course. So now that we've pretty much covered all of our bases, we now need to go into how the market truly works and how each week is depicted in the market and how each and every single candle is printed based off a monthly, weekly, daily, and so forth time frame, and how the market delivers price week in and week out, because every week price is set before the week happens, and every week the same cycles of liquidity happen. So in this video, we'll be going over the power of time and price, because everything in our recent videos will not work if time is not in place and price delivery is not in place. Because again, you cannot take a 5-minute Asian break to the upside on a 1 hour and 4 hour downtrend during New York session and London session, because you'll just get blown out. So we'll be covering how time and price is extremely crucial, because price is time sensitive, and that's how the algorithm works. We'll be going over our daily cycle, which is our London open kill zone, our New York kill zone, our Asian range, and our central bank dealing range, which is our Frankfurt buildup, and our liquidity buildup that sets our high of the day and low of the day after the session and the trading cycle has been completed for that day. So keep in mind, even though we have our sessions, how the day works is simply based off our liquidity and what ranges and cycles we're going to go to target to follow overall order flow. So we will be going over each and every cycle that happens within the daily cycle. One of the most crucial, which is our Asian range, our London open, and our New York open. We'll be going over our liquidity buildup during when there's no sessions in play, and then how the market sets a weekly and daily high and low, and how those create our strong highs and lows that create our targets of liquidity. And it happens each and every day, which is how we form our pools of liquidity in the market, whether it be internal or external. So going in, just showing a rough example. Usually the market will have, so at 5 o'clock New York time, when spreads open and the market is extremely volatile, not volatile, but our spreads go to 50, 70, 80 pips. We have our high of the day set, and then we have our low of the day that's set. And these can happen in New York or London session, but it's when our official trading day is over. So we have our high of the day and low of the day. But what does that really set in the market? It sets our strong highs and strong low of external liquidity that creates our liquidity pools that we're going to target for the next day. So we'll have our highs and our lows, right? We'll have that. So this could be the previous day high, the previous day low, and now we're building in internal liquidity to target. So you will get these in your New York session and your London session, but within here, when the session closes and Asian opens, we'll have our Asian buildup, which is our Asian range, which you never want to trade. So you want to trade your London open, which is at 3 a.m. New York Eastern Standard Time, and our New York open, which is 8 o'clock. Now, the most juiciest moves usually happen at 9:30 a.m. New York time, Eastern Standard Time, because that's when the stock market officially opens and you have that extreme influx of orders and liquidity being pushed into that volatile market. And that's when you start to get aggression and you start to see the actual banks and financial institutions print their orders. So again, you have that algorithm, which is when the market closes, because there's no physical traders there. They have that algorithm, which is the computer building liquidity, right? Which is our buildup within our Asian range. So this is known as our cycle, our Asian cycle. And it's just how the market and algorithm builds up to target when time and price kicks in with that 3 a.m. open and that 8 a.m. open. Again, 9:30 is usually the volatile time because that's when the stock market opens. But again, those are our sweet spots, anywhere from 3 all the way into that New York close at 11. So again, depicting off our daily cycle, how everything gets built up. So we have our highs and our lows. Price accumulates and creates that Asian range. Let's say we're looking for sells here because we had the move up that ran external liquidity. The move down failed to break, but then we failed to break the high. So we ran liquidity on the sell side. to create the buy, but look how it's not breaking structure. So we're getting that Asian buildup. So we have our internal liquidity right above and below. We already ran it on the high. So let's say we ran that on the high, right? We have our other pools of external within our internal. So we have our Asian buildup that occurs, London open, price swipes up, right? We clear that previous daily high. We take out our Asian range. So we take out liquidity, but what are we doing? We're respecting our what? Our strong high, that previous daily high from the other day that was never mitigated or tested. So again, we'll usually have our London open, price will break structure. So we have our time, we have our next run on liquidity, but because price ran that external, what do we need? We need that pullback to confirm. Price hit the order block or the breaker. Usually we'll have that buildup of liquidity, which will be like our Asian range. We'll get that New York open. So you have your New York open. And what does price do? Price continues the move until it runs that next pool of liquidity. And this is how the daily cycle works. This is how price creates and generates liquidity to create moves in the market. So again, nothing happens without liquidity. You have your whole day, which is depicted here, right? With your daily highs, your daily lows, you have your Asian range build up, which creates that liquidity buildup. It's where price is not creating structure. You're just getting that buildup when you have those aggressive moves. You have your cycles, which is your New York open, your London open, your Asian buildup, and your high of the day and low of the day that gets set. And then just the power of time and price is which your session is, where banks actually show us their hand and then we execute based off those moves. So again, let's look at some examples on the charts based off our higher time frame. So this is this current week. We'll take a look at this. Go ahead and erase all this, clean it up a little bit. All right. So we're just going to look at our 4 hour. Obviously, price and order flow is what? Bearish. Why? We're creating lower lows, lower highs, lower lows, lower highs, lower lows, lower highs, lower lows, and we're running liquidity on each sell side point and failing to form new structural highs. So again, what are we really doing? We're targeting a higher time frame liquidity pool right here on the external point. This is still an internal range on the weekly, but on an internal range on the daily. So we're targeting that next actual point of external liquidity. So again, we're going to look at this current week, and what's been happening. So we have our week that's been depicted here. That's where the week started. We have our week here, and this is where price is at right now. So this is our current week. And now we're just going to dive in and look at how timing and price lines up with each of our entries and overall order flow, and how we tie each and every single thing together to build our basis, which is our runs on liquidity. So on the 4 hour, we don't see too much craziness. The 1 hour is where we could really start to depict a lot. So on the 1 hour, right off the bat, we can see our last structural point where price came up, failed to make a high, and then this whole leg did what? It confirmed our new low. So now we choose our valid point of interest, which is our hidden order block, right? What do we have here? We have that internal point of liquidity. So here's our internal point of liquidity that we need to run. Again, we have that order block, that clean order block that price should not take out. And then the high of that wick, because this created a new low, that was the new high, and it came down. So that's why I depicted it with a line, because price should not trade above this wick. But here we have that added confluence of our order block. Again, this is our liquidity buildup. Now, why is this our liquidity buildup? Yes, you have your clean buy entries with New York and London, for example. Here was your London open. Again, London open didn't give us anything so far. So that's already our first sign of a smart money trap, but we'll get into that later in the video. So right there, price failed to break structure. Again, it pushed up and it did, and New York open confirmed it. So here you had clean buy entries. The only issue, and then once we took out that liquidity point, price failed to break structure to the downside. My only issue is, look at how the high of the day was set. So right here is where we had that high of the day that was set, and that was that low of the day. Look at what we talked about in the previous videos. What's happening? Momentum is slowing down, and we're starting to not mitigate orders. And what do we have all in here based off our higher time frame? All of this is liquidity because we haven't ran any lows. Now here we have that clean move down, and we're targeting that next liquidity point. So again, now we're just looking based off our session open, how price wants to form. So again, here was our London open, came down, price pushed up, we came into New York and we completed those buys. But again, price has not officially broken the highest structural point. So we're all still within internal structure. So yes, we had clean, valid buys within our sessions, but based off all of our narratives in the basis of liquidity, now we have to come down. If price really wants to break the structural high, it has to come down anyways and take out these points of liquidity that are resting all right in here. And then it would have to respect the hidden order block that's within here. So again, look at how price reacts though because of the higher time frame narrative. So once we hit our valid point of interest, right? Once we hit it, we can see we're within the Asian session. So we're not taking any trades in here. We're waiting to see how this last order block wants to hold, right? As we can see, obviously it didn't. So now here was our London open. London open occurred and price melted, but that's okay. We don't have to force any entries. Yes, you could have taken this entry, but again, this is risky and this is right before London. So we're not going to force it. But again, what did I tell you about that New York open in that sweet spot? So again, we tie everything together. We can see how price officially has formed a new low and how it's ran liquidity. So once it comes up, no structure is formed. There's no internal liquidity. If anything, the internal point of liquidity is here. So let me go ahead and remove that, right? Here is our internal point of liquidity, which is this high. Why? Because it's high. Did it create a new high and then create a new low? No, it did not. You might think it created a low, but it didn't because look right here. The new low was not established. This was just that run on liquidity. So again, price comes up, we hit the breaker, and now what was I talking about? The power of time and price. Here's that 930 open. It comes down. We get that internal swipe on liquidity because this is not valid structure. And here's your sniper entry. Still within New York session, playing off the breaker. Again, why is this not valid? Because we cleared an external point of liquidity and no new structure was formed, and we're playing off this breaker because a new low was formed. Again, London session was not validated here, but look at what London actually did. The open of London created the low. So coming into New York for that pullback, we're getting that liquidity buildup. The Asian session range wasn't ran out. It will be ran out later, but London open took out this accumulation. This is that high of the day, and price formed a new low. So once we come into the breaker, after we get that internal run on liquidity, since this is a false higher high, then we get the move down, and our next target is this new low because this low was not false. Because this low was false. So again, based off that higher time frame narrative, we can see it a lot cleanly. The break, again, pull back to the breaker, and we have our entries. Now let's go ahead and look at how the next day formed. Again, going into our smaller time frame, you can see off the bat, what do we have? We'll have our breaker. So again, no liquidity here. And this is on the smaller time frame, but we're going to go based off the higher one. So again, we have our added confluence. That's our breaker, Y, imbalance. So we had the imbalance, price came down, successfully mitigated, and then price broke down. So we're taking the breaker with that added confluence of the order block. So again, this is our Asian range buildup. We need to find our London open. So here's our London open, price comes up, and what does it do? It swipes the last high of that Asian range. We took out the low, now we're going to take out the high. Coming into New York Open, price comes down, fails to push up off the order block. So we're taking what? The breaker. Now, why the breaker? Because this is that imbalance. And then you have that clean entry, and look what happens in New York. As soon as that open comes at the 9:30, price melts and we have their entry. But look at where we have another re-entry for the next day at the footprint. And we're all building in aggression and everything. Also, this was London Open. What is this? That previous Asian high, because this is all your Asian range. So it happens day in and day out. Asian range high, price breaks down. Let's say you didn't want to take the entry there. You get the break of structure here. We get the pullback. Again, this is in New York session from London. You have that false liquidity buildup because this is not a valid order block because no structure was broken to the upside. And you have another re-entry there. So again, the power of timing and price, the liquidity buildup, and how the cycle of the day works. Your Asian range, your previous daily high, previous daily low, price comes up, New York Open, takes out this internal liquidity, hits the order block that was validated from the previous New York session, break in structure, liquidity buildup, pullback, New York entry, and then price just distributes lower and lower. Again, don't get caught up on these smaller time frame pullbacks because we're all playing it off the higher time frame, right? Again, we can see it a whole lot more clearly. That internal liquidity, clean order block, breakdown, run on internal order block, and every entry is if in London or New York. Sometimes, so the market's not perfect. Sometimes the algorithm will create moves, but you want to look at those session opens and what actually created, because this was that London Open. So going into today, right, we had the breakdown. This was our trap. Why was this our trap? Because this was after New York session close. So this was that central bank dealing range coming in. This was your Asian range, and we'll show it on the lower time frame. But again, anytime we build in price and timing, what do we want to build in with it? Structure, liquidity, order block, breaker block. So what do we have here? We have clean imbalance. Price came back, mitigated the order block. So we're looking at this breaker. And then we're looking at, why are we looking at this? Because that's that internal liquidity that was never ran. So this was a trade I took today based off all of my time frames. So I looked at the 15. I saw the internal liquidity, my breaker block, where price created a low, mitigated. So here I had the added confluence of what? My order block were really breakers. So we're taking the two candles because this is clean and balanced. More so looking at the run here to come into here of the point POI and just have somewhat of a reaction. Right, perfect touch. Again, no structure was formed here. So here's your liquidity buildup. Here's your Asian range. Price runs it. And then I went down to the smaller time frame. And then this is where we can see how we get really tight stops and sniper entries based off all of our confluences adding up. So here's your Asian range. This was your London Open, right? So what did we do on London? Price opens up. We push down. We get a minor break in structure, but we don't get that full on. So I waited for that run on liquidity to confirm. We run up, right? We're still within our point of interest. And what do we get? We finally get that build up. Price runs up, takes out the high. This is New York session. We get the full on break of structure from London. Pull back to what? The order block. Now, why are we not taking the breaker? Because you can see within this wick, that's that last point of internal liquidity that was formed. And then we get our entry. When? Right at that New York Open. And what does price do? Just continues down and finally distributes. Now we're getting that pullback, but again, what is this? This is Asia, so we'll have that Asia run on liquidity, London Open, and we'll continue lower because no structure is being formed, right? So this is how you just build in narratives and build in everything and start adding everything little together piece by piece because you have everything that lines up. What do you have? You have your daily cycle, you have your daily cycles. You have your weekly highs, weekly lows, daily highs, daily lows. You have the power of timing and price. You have your sessions, which is your Asian cycle, your New York Open, your London Open, and the times depicted. You have your buildup and how liquidity works. So the market is solely based off liquidity, but it has timings with it, and you cannot take trades if timing and price is not in play. So here, I just want to show another example of a trade that I showed earlier in one of the videos and the outcome. So again, I was in sells here. And why did I keep holding the sells? Simply based off what I know and how the market works. No low, no high, no low, no high, no low, price coming to take the low. Why? Because the narrative that was built in and how price reacted as it was coming up and now it was coming down. So here, what do we have? A smart money trap. No structure was broken, and we need to target external liquidity. Now, here, what do we have? The Asian range, the swipe, London Open, the move down. See how aggressive the move is. Again, coming up, that's our liquidity buildup. Again, with our Asian range, price comes down. And what do we have here? Our London Open comes up. And what happens? New York swipes that internal point, plays off our breaker. And then we have the full meltdown on liquidity and that we're targeting. So timing and price is so crucial in tying every single thing together in the market. A lot of people would have thought buys would occur because we take out this high. Yes, but not right now. You have to follow price. So right now, our extended target is running, and we're running almost a 1 to 21, simply because we know how to tie things together and getting that sniper entry on that pullback. Again, stop above. So timing and price is extremely, extremely crucial because New York session, even though we didn't get the break in structure, we had our liquidity built up there. There's no liquidity that was being built here. It was being built, as you can see here, and then we're having the strong moves down to clear it. But going into that New York session, here was the clue that gave it away. The run on internal liquidity, the play off the breaker, because you're having no successful moves to the upside. No structures here, no structures here, and we're not playing off anything. So again, breaking it down to a smaller time frame, price takes out internal liquidity, plays off the breaker. You can even see on the 5-minute, the low took in, price was mitigated. So price should not take out this order block, which it did not. Sorry for the colors, it's a little bit, right? So price did not take it out. And then what happens as we hit it? Because again, this is all New York session. We get the low, price fails to make a high, and we get the new low. Internal liquidity swipe shouldn't take out the last mitigated wick. So I'm looking for that last swipe there. And this would have been the cleanest entry. Again, the new low gets formed. Full on break, pull back to the breaker, swipes the internal liquidity right there. It happens on every time frame, day in and day out, right? Play off the breaker. And this was the telltale sign that price was going to go down. So again, timing and price, your cycles, your daily highs and lows is so crucial and so important, but keeping in mind as long as it lines up with liquidity. So I hope this video helped, and we'll see you in the next one.